On September 18, 2025, the Federal Reserve surprised many by cutting its benchmark interest rate by a quarter point. This move marked the start of a new easing cycle after years of rate hikes to combat inflation. Understanding this development requires us to look closely at why the Fed did this and how it ripples through the economy. In this video, we will analyze in detail how this Fed rate cut could affect your personal finances, from the interest you earn on your savings to the mortgages you pay, from your retirement nest egg to even the cryptocurrency markets. We'll cover both the basics and the deeper impacts, so whether you're an intermediate or advanced investor, you'll come away better informed. First, let's set the stage. Throughout 2022 and 2023, the Fed raised rates repeatedly to fight high inflation, eventually bringing the federal funds rate up to around 4.3%. By mid-2025, inflation had started to cool and economic growth was weakening. In response, the Fed cut rates by 0.25 percentage points in mid-September 2025, lowering the funds rate to about 4.1%. Fed officials indicated this might be the first of several cuts. The Fed's own projections, the dot plot, suggest two more cuts by year-end 2025, aiming for a target around 3%. In plain terms, the cost of short-term borrowing is set to fall gradually through 2025 and into 2026. This shift has broad consequences because the Fed's policy rate influences many other rates across the economy. One of the most immediate places you'll see an effect is in deposit rates. The Fed does not directly set the interest rates on savings accounts or CDS, but banks and credit unions almost always use the federal funds rate as a guide. When the Fed's rate goes down, banks typically cut the annual percentage yields, APYs, they pay on savings, money market accounts, and certificates of deposit, CDS. After a period of ultra-high rates, when the Fed was raising aggressively and banks were offering 4 to 5% APYs to savers, this rate cut signals that those yields will start drifting lower. In practical terms, if your high-yield savings account was paying, say, 4.5% in early 2025, you might see that rate inch downward in the coming weeks or months. However, it's important to note that even after a cut, savings rates will likely remain higher than the 0 to 1% we saw for most of the last decade. Many high-yield accounts and CDS still offer several percentage points above the national average. Savers should use this transition period to lock in strong rates. For example, if you have a 12-month CD paying 4.2% today, you might consider locking that in now, because if more cuts come, banks will eventually reduce yields. The key takeaway for savers is that while your deposit rates are likely to fall, the changes will be gradual. You won't see your bank's rates suddenly collapse overnight. But over the course of months, banks will trim rates to preserve their profit margins once the Fed eases off pressure. If you're saving for an emergency fund or a short-term goal, try to lock in higher rates as long as you can, or shop around for the best offers. At the same time, inflation is still a factor. If inflation remains above the Fed's 2% goal, as it does currently in the low 3% range, even high deposit rates might not fully keep up with rising prices. A lower Fed rate can put mild upward pressure on inflation, which means that the real inflation-adjusted return on your savings could shrink. This makes the chase for the highest yields even more critical. Money market funds or short-term bonds could become relatively more attractive, but they are also influenced by Fed policy. In summary, expect a slow cooling of bank deposit rates, but still enjoy historically decent yields for now. Savers should stay vigilant, lock in high rates when possible, and understand that any increase in inflation could erode real savings returns over time. If you're getting value so far, do me a favor. Hit like and subscribe. We keep sharing finance and wealth building strategies like this, and we don't want you to miss out. Now let's talk about mortgages and loans. A common misconception is that when the Fed cuts the federal funds rate, mortgage rates follow immediately. In reality, mortgage interest rates, especially on 30-year fixed loans, are more closely tied to long-term treasury yields, like the 10-year treasury note, than to the Fed's short-term rate. A single 0.25% Fed cut often won't instantly shave a full point off mortgage rates. In the short term, the September 2025 rate cut itself likely had a minimal direct effect. In fact, shortly after the announcement, 30-year mortgage rates ticked around 6.5 to 7%, still near their lowest levels of the year, but not dramatically lower because bond markets also reacted to inflation and economic news. However, what does move mortgage rates is expectation of cuts. The Fed indicated there could be 2 more cuts this year, aiming to lower the funds rate to around 3%. That forward guidance is significant. Investors now expect looser monetary policy, which tends to push down long-term rates. As long-term treasury yields fall, mortgage lenders can afford to offer slightly lower rates. Therefore, over the next months, we should see mortgage rates gradually easing. For example, some home buyers and refinance seekers might already be finding rates about a quarter point lower than a month ago, and potentially half a point below early summer levels. This incremental drop in rates can significantly increase home buying power. Reports suggest that a drop of even half a percentage point could add tens of thousands of dollars to what a borrower can afford on a house loan. Importantly, the economy economy and inflation dynamics will play a role. If cutting rates leads to higher long-term inflation expectations, that could actually push 30-year mortgage rates up instead of down. Some economists warn that if investors fear inflation, they will come roaring back. Perhaps due to big federal deficits or tariffs, they will demand higher yields on long bonds. Right now, inflation is above the Fed's goal and has been very sticky, so any sign that the Fed is ignoring inflation might cause concern. But assuming inflation continues to ease toward 2 to 3% and economic growth is only moderate, the trend should favor lower mortgage rates as the Fed cuts further. For potential homebuyers, the takeaway is don't expect an overnight plunge in mortgage rates, but do expect gradual relief. The affordability crunch of 2022 to 2024, when 30-year rates were in the high 6s and 7s. By late 2025, mortgage rates could be back around 6% or even below if the Fed follows through on its plan. Current homeowners with ultra-high pandemic rates, like 7 to 8%, will particularly benefit. If you locked in a 7% rate 2 years ago, refinancing to a mid-6% rate could save a few $100s a month. However, it's wise not to refinance immediately. Wait and watch a bit. If rates go lower as projected, you could save more. But don't wait too long if you need cash or want stability, since forecasters always have uncertainty. Beyond mortgages, other consumer loans respond too. Auto loan rates and credit card rates tend to be sticky but eventually move. If the Fed's cycle reversal is a real trend, new car buyers may see a few percentage points off those sky-high rates of recent years. But it will take time. Lenders often price auto and credit loans based on their own models and may hesitate to cut rates right away if they fear inflation. In short, borrowers will gradually reap the benefits of a softer Fed, but not instantly. The Fed's move also matters a lot for stock and bond markets, which in turn affects your investment portfolio and retirement accounts. When the Fed cuts rates, it usually has two main effects. It lowers yields on relatively safe investments like treasury bonds, and it signals a more supportive environment for riskier assets like stocks. Let's start with bonds. If the Fed's cut and forecasts of future cuts push down treasury yields, then bond prices move up. That's good news if you already hold bonds or bond funds. Their value increases. But if you're buying new bonds or starting a CD, the yield you can lock in will be lower. This is similar to the savings account effect, but on a larger scale. A portfolio heavy in fixed income, like treasury bonds, municipal bonds, or corporate bonds, will see its overall yield shrink over time. For retirees who rely on bond interest for income, this is a downside. Their income from these safe assets will gradually decline. However, the flip side is that stocks typically benefit from lower rates. Lower interest rates reduce borrowing costs for companies, potentially boosting profits. They also make dividend-paying stocks and other yield-generating investments more attractive compared to now falling bond yields. Historically, stock markets have often rallied after Fed rate cuts. In the short term, the stock market may be volatile as traders digest the news, but the overall trend with more Fed easing is usually upward for equities, particularly stable companies with strong dividends, often called dividend aristocrats or dividend kings, could see more investor interest as people seek yield outside bonds. Financial stocks, banks, insurers may also do well if the rate cuts stimulate loan demand and improve economic growth, even though lower short rates can compress bank profit margins. A modern twist is crypto. Bitcoin and other digital assets are generally considered risk assets, more aligned with tech stocks and Nasdaq than with, say, gold. Many analysts note that Bitcoin's correlation with the S&P 500 has been high, and when equities rally on Fed easing, crypto often follows. Moreover, a Fed cut usually puts mild downward pressure on the US dollar. A weaker dollar has historically been a positive for Bitcoin, since Bitcoin is often viewed as digital gold. If the Fed lowers rates and the dollar softens, some investors might flow into Bitcoin and other crypto as an alternative or hedge. Institutional investors are now deeply involved in crypto markets, so ease in monetary policy could trigger inflows into Bitcoin, ETF, and the like. That said, crypto remains very volatile. The initial reaction to the first 2025 cut was muted. Cryptos didn't instantly skyrocket because markets were already anticipating this move. But if the Fed continues to cut, the environment will be more risk-on, which typically benefits crypto. We should be cautious, however. Crypto prices will also react to regulatory news, global events, and technology factors. In summary, expect a constructive environment for equities and crypto with the usual caveats of risk. For typical retirement or investment portfolios, a balanced approach is key. Bond-heavy portfolios may struggle to generate as much income, but can still offer stability. Stocks, especially quality dividend stocks, might do well. This is one reason so many advisors say retirees should not be panicked just because rates dropped. Instead, they may need to slowly shift some assets toward equities or other growth investments to maintain income potential. Real assets like gold can also be discussed. Gold often rises when real interest rates fall, which can happen if nominal rates drop, while inflation remains above 2%. In our scenario, inflation is still a bit high, so gold and other precious metals could also benefit as a hedge. Delving more into cryptocurrency, as noted, Bitcoin tends to benefit when liquidity conditions improve. A 0.25% cut is modest, but it signals that by mid-2026, the Fed may have eased by over a percentage point in total, bringing the terminal rate near 3%. Analysts note that such easing often coincides with rallies in Bitcoin and altcoins. Lower U.S. interest rates mean cheaper financing for speculative investments, and they often weaken the dollar, making dollar-denominated crypto slightly more attractive globally. One way to think about it, Bitcoin is often called digital gold, in part because it reacts similarly to an asset that investors use when they fear a weakening dollar or higher inflation. If easier policy leads to the dollar losing a bit of value, Bitcoin could regain some of that macro hedge appeal. Also, institutional interest in crypto is at record levels. For example, futures open interest and Bitcoin ETF flows have been very high in 2025, meaning big players who watch Fed policy closely may be poised to allocate more to crypto as the Fed eases. Historically, after Fed rate cuts, Bitcoin often sees a surge in the following months. Altcoins, like Ethereum or smaller projects, typically move in the same direction as Bitcoin, although they are more volatile. However, stablecoins, cryptocurrencies pegged to the dollar, might see a squeeze because their issuers earn less from their reserves when short-term rates fall. Decentralized finance protocols that rely on lending and borrowing might also see adjustments, as the interest rates in those systems could change. On balance, though, the crypto market is likely to view Fed cuts as bullish. The real-world impact to track will be the US dollar index, treasury yields, and the stock market. If those move in the expected directions, crypto will probably follow suit. For retirees and those approaching retirement, the news is mixed. On one hand, if stocks do better in an easing cycle, that could help 401k balances and IRA portfolios, assuming you have equity exposure. On the other hand, many retirees are more conservatively positioned, relying on bonds, CDs, or annuities for income. Those assets will yield less as rates fall. A financial planner we cited points out that lower rates effectively fuel the money supply a bit, which can translate into higher inflation over time. Retirees who often live on fixed incomes can be hurt by this if their purchasing power erodes. What this means practically, retirees should revisit their budgets and plans, but not make hasty decisions. They might consider maintaining a ladder of bond or CD maturities, so some keep locking in yields before they fall, and keeping some money in equities for growth. The point is to find balance. Have some money in safer assets for stability, but don't sit entirely in cash or bonds if those yields will sink. Many advisors suggest dividends, dividend ETFs, and quality corporate bonds as alternatives, since corporate bond yields often stay a bit higher than treasuries, even when the Fed cuts. Ultimately, consistent planning with a focus on your income needs and inflation protection is key. Speaking of inflation, what does this rate cut itself imply for inflation? The Fed usually doesn't cut rates unless it believes inflation is under control or the economy needs a boost. In our case, cutting at 3% inflation is above the target. This suggests the Fed is prioritizing the slowing economy and labor market weakness over fighting inflation right now. If the economy responds to these cuts, there could be upward pressure on inflation. Consumers and businesses might spend more when borrowing is cheaper, potentially reigniting price pressures. If inflation reaccelerates, the Fed may have to reverse course later. But for now, with inflation moderately above goal, the risk of a small uptick exists. In short, the Fed cut helps stimulate growth, but raises the chance of inflation drifting up or coming down more slowly. For your personal finances, that means the cost of living could still rise faster than incomes, making it even more important to seek investments that outpace inflation over the long term. The Fed's 2025 rate cut has clear and far-reaching implications. For savings, expect a gradual reduction in interest earned on deposit accounts. Focus on locking in good rates while they last. While for mortgages and loans, look for slowly declining borrowing costs. In the coming months, mortgage rates should ease, offering relief to home buyers and refi seekers. For investments, stocks and crypto are likely to enjoy a tailwind as money flows out of now lower-yielding bonds. Bonds and safe assets will offer lower returns. For retirement, fixed income streams may shrink, so retirees need a balanced approach to protect purchasing power, but they'll benefit if equities rise. While inflation could tick up as the economy warms, so keep an eye on price levels and adapt your portfolio accordingly. The key is to stay informed and adjust where needed. This rate cut wasn't a sign that inflation is solved. It was a sign that economic growth needed a boost. For savers, borrowers, investors, and retirees alike, the strategy is to take advantage of falling rates where it benefits you, like cheaper loans and strong locked-in yields, and mitigate the downsides, such as exploring alternatives to low-yield bonds or protecting against inflation. By remaining flexible and thinking in intermediate to long-term terms, you can navigate this changing interest rate environment. Thanks for watching.